Welcome to the Deep Dive, where we perform a financial deep tissue massage on complex company reports. We take the mountain of press releases, analyst consensus estimates, and dry balance sheet figures and reduce them to the only 5 critical takeaways you actually need to understand what's moving the needle. Our focus today is Lucid Group, Inc., that's LCID, following their Q3 2025 earnings release. And this was a quarter that immediately threw the financial world into a bit of a spin,
Well,
really.
quite a bit of confusion out there.
Exactly. The headlines were all over the place. The company's overall net loss actually got worse, substantially worse year over year, yet somehow the loss reported per share looked better on the surface. So that's a paradox we absolutely need to unpack.
Yeah.
Beyond that, our mission, is to cut through all that noise and really find the single central financial pillar that's holding this whole thing up. Because the quarterly cash burn confirmed in these documents is, well, it's truly massive.
It really is.
So we're tackling this with our structured 5-part framework, integrating the company's own data with, let's say, the harsh reality of market expectations.
And that structured approach is really critical here, isn't it? I mean, Lucid is the classic high-growth, capital-intensive startup. They're a luxury automaker trying to scale production. And for companies like this, context is just everything.
Right. You can't just look at one number.
No way. If you just read the summary sheet, you completely miss the profound contradiction at the heart of their performance. Our deep dive, I think, reveals a real duality. On one hand, yeah, they achieved some surprising revenue strength, sold more premium vehicles than the street thought they would.
Which sounds good initially.
Initially. But on the other hand, that little bit of success was just completely overshadowed by what you really have to call catastrophic cost control failures. We're going to pinpoint exactly where those costs just spiraled out of control and explain the long-term implications for, viability when you're spending nearly $2 to generate $1 in sales. It's just unsustainable.
Okay, let's unpack this then. We're starting with the bird's eye view. The first impression, comparing the company's official numbers against what Wall Street expected, what they'd priced into the stock before the release.
All right, let's get into it.
Now for slide 1, the at-a-glance scorecard. So we kick off with that headline conflict, the immediate point of dissonance. Lucid reported total revenue for the quarter of $336.6 million. Now, Wall Street consensus estimates, they had the target lower at $325.6 million.
Right.
So on the top line, the revenue, the company delivered a clear beat. From a demand perspective, that sounds positive, right? They moved more product than anticipated.
It sounds positive, yeah, until you look just one line down at the bottom line. And that's where the market's patience just, evaporated immediately.
The EPS number.
Exactly. The second headline was the severe earnings per share, or EPS, miss. Lucid reported a diluted loss per share of $3.31. Analysts, based on their models, their volume forecasts, they'd only anticipated a loss of $2.32 per share.
Wow, so that's nearly a full dollar per share difference.
It is. And that gap represents a significant failure in meeting profitability expectations. A huge miss.
So we have the classic beat and miss scenario, but this sounds like an extreme version. They managed to sell, a few more cars maybe, but the sheer cost of actually delivering those vehicles and running the business meant they lost dramatically more money than every single analyst expected.
Yeah, that's the crux of it.
And the market is always brutal in these situations, isn't it? It just ignored the top line beat entirely.
Completely ignored it, yeah. The market's focus, especially for a growth company like this, it's always on future cash flow and profitability. The stock price reaction was the clearest signal of sentiment. Immediately after the announcement on November 5th, 2025, shares fell, 3.42%? That's about 59 cents down in after-hours trading.
Ouch.
Yeah. And the initial analyst notes that they confirmed this negative sentiment. They quickly shifted from maybe neutral to cautious, just citing that the results fell significantly short of Wall Street expectations on the profitability side. The revenue bump, barely a footnote.
Okay, here's where it gets really interesting, though, and where we tackle that first part of our listener's mission, resolving that core contradiction. Because when you actually pull back the curtain and look at the raw GAAP numbers, generally accepted accounting principles, the total net loss for the quarter actually widened year over year by 8.9%.
Right, it grew.
It grew from an already substantial loss of about $950 million in Q3 2024 to an even larger loss of over $1 billion, $1,034.5 million this quarter. That's nearly a $100 million increase in the total loss. I mean, by any measure, a widening total loss is deeply concerning.
Agreed. That's $1.034 billion hole in just one quarter. That's a staggering figure for a company of Lucid's size.
Yeah.
Really staggering.
Yet we have this bizarre paradox, right? The diluted loss per share narrowed. It showed an apparent improvement of over 19%, dropping from $4.09 last year to the $3.31 reported this year. So how on earth can the corporation lose more money overall, but the loss per share suddenly looks better? I mean, this seemingly impossible financial outcome, it's got to hide the true cost to existing shareholders.
It absolutely does, and this raises such an important point about financial literacy, really.
Yeah.
How savvy investors, how you need to read these reports. You have to look beyond just the headline metric. We need to distinguish carefully between basic EPS and diluted EPS.
Okay.
Basic EPS is pretty straightforward. It's just the net loss divided by the shares that are currently out there in the market. It's the simple current reality.
And diluted EPS, that's supposed to be the worst case scenario, right?
Yeah.
Accounting for everything.
Precisely. Diluted EPS is designed to be a conservative calculation. It takes that net loss and spreads it across not just the current shares, but also every potential share that could be created. Things like convertible debt, employee stock options, warrants, you name it. It tries to project the maximum potential harm to the per share value.
Okay, so the total GAAP loss actually got worse, bigger loss, but this conservative worst case per share loss figure got smaller. The only variable that could have possibly changed dramatically enough to cause that swing is the denominator, the total number of shares you're dividing by.
Bingo. You nailed it. The answer to the paradox is found right there in the notes section. Shareholder dilution. Massive shareholder dilution. We look at the weighted average diluted share count. That's the figure they use in the calculation. Lucid's share count exploded. It went up by a massive 4.3% year over year.
34%.
Yeah. It jumped from 232.4 million shares in the prior year quarter to 312.2 million shares in Q3 2025.
Wow. A 34.3% increase in the share count in just 12 months is, well, that's not a minor event. That's huge. That's like existing shareholders seeing their proportional stake in the company shrink by almost a third purely to raise capital or pay employees, right?
That is the core conclusion, exactly. The apparent improvement in EPS. It was entirely an accounting illusion. It was driven by this massive infusion of new shares, a clear sign of significant capital raising and dilution. The underlying total operational performance actually worsened, but that bigger loss was simply distributed across 34% more theoretical owners.
So it just makes the per share number look less bad even though the company bled more money.
Precisely. And it confirms that just relying solely on the headline EPS number, especially for these cash-hungry growth companies, is a massive mistake. You have to look deeper. The real cost to the existing shareholder was that steep dilution.
Okay, so let's put a pin in that. The 34.3% dilution means existing shareholders' slice of the ownership pie shrank by over a third in just 1 year, basically just to keep the lights on and finance the growing losses. That sets a profoundly negative tone, doesn't it?
It certainly does.
So we've established the outcome, a larger total loss funded by dilution. Now we have to address the root cause. Why are the losses so big in the first place?
Right. It's time to examine the operational efficiency, or lack thereof. We now move from the outcome to the machine itself, the engine room.
Moving to slide 2, the engine of profitability. Right, to really understand the root cause of that, over $1 billion GAAP net loss, we had to look inside the gross margin calculation. For any manufacturing business, especially autos, this is the ultimate brutal test, isn't it? Are you selling the product for more than it costs you just to build it? Forget R&D, forget marketing for a second, just the build cost.
That's absolutely right. Gross margin is simply revenue minus the cost of goods sold, or COGS as it's often called. If that number is negative, well, it's not just a red flag. It's basically an economic crisis for that product line. It means you are losing money on every single unit you ship, even before you factor in all the other heavy costs like research, sales, general admin expenses.
Okay, let's run Lucid's Q3 2025 numbers using their official filings right here. They reported revenue, we said $336.6 million. Shockingly, their cost of revenue, their direct production cost, was $670.2 million.
Yeah. And when you do that simple math, revenue minus cost of revenue, the result is a gross margin of negative 99.1%.
Negative 99%.
Negative 99.1%. It's statistically almost unbelievable and frankly unsustainable. It means that for every single dollar of revenue Lucid managed to bring in from selling one of its admittedly luxurious vehicles, they were spending $1.99 on the direct costs. That's the components, the labor, the factory overhead, just to build that specific vehicle and get it out the door.
Losing almost a dollar for every dollar they make just on the production, negative 99.1%. That's not just unprofitable. That indicates the core economics of the manufacturing process itself are fundamentally broken right now.
That's a fair assessment.
It means the company is massively subsidizing every single car it sells. And the scary part is, the larger they scale under these conditions, the more money they lose, just mathematically speaking.
Exactly. And just to put into some industry context, right? When Tesla was in its own massive scale-up phase, say between 2017 and 2019, yeah, they faced huge profitability challenges, production hell, as Musk called it. But their gross margins rarely, if ever, dipped into this kind of catastrophic negative range for extended periods, certainly not approaching negative 100%.
So this is worse than Tesla's worst days on this metric.
On this specific metric, yes. It suggests that Lucid isn't just following the, let's say, difficult path of a startup automaker, but potentially setting a new low in unit economics right now, likely due to some very specific issues we can maybe touch on later, supply chain, factory inefficiencies, things like that.
And remember, that negative 99% is just the gross margin. If we zoom out to the full picture, we look at the operating margin. That includes not just the cost of goods, but also all the operating expenses, the R&D, the selling, general, and administrative SG&A costs. That measures the overall operational efficiency.
And as you'd expect, the loss balloons dramatically then. You have to factor in, let's see, $325.3 million spent just on research and development in the quarter, another $283.1 million spent on SG&A that covers marketing, executive salaries, all the corporate overhead. So the total loss from operations came in at a whopping $942.0 million.
Wow.
Yeah, and you put that against their modest revenue of $336.6 million. The operating margin hits an absolutely astonishing negative 279.9%.
Negative 280%. Let me just summarize that number for the listener. That means they incurred a total operational loss of $2.80 for every single $1 they earned in vehicle revenue.
That's right, $2.80 loss for every $1 in.
It just vividly illustrates the sheer breathtaking magnitude of the cash burn required simply to keep the doors open, keep operating, and keep developing the next generation of product.
And these massive losses, they're intrinsically tied to a really fundamental concept for automakers, which is operating leverage. This is kind of the long-term hope, but it's also the short-term killer.
Okay, let's unpack operating leverage clearly, because this sounds like the foundational financial bet that Lucid's leadership and presumably the PIF are making.
Right. Operating leverage basically measures the relationship between a company's fixed costs and its variable costs. Fixed costs are things that don't change much, whether you make one car or 100 cars. Think the physical factory building itself, the major assembly line equipment, the core R&D teams, huge upfront investments.
Got it. Costs that are there no matter what.
Exactly. And then you have variable costs, like the specific battery modules, the aluminum sheets, the tires needed for one single car. Automakers, by their very nature, require immense initial capital expenditure, which gives them extremely high fixed costs, and that results in high operating leverage.
Okay, so high fixed costs mean high operating leverage. It sounds like it could be a guaranteed profit accelerator if things go well, but also a massive magnifying glass for losses if things don't go well.
That's precisely the double-edged sword. The risk. Well, that's what we see playing out right now in that negative 99.1% gross margin. That's Lucid's current reality. They absolutely must sell immense volumes of vehicles to absorb those massive fixed factory costs and finally reach the break-even point.
And they're nowhere near that point now.
Miles away. Because their sales volume is currently low relative to the factory's capacity, those high fixed costs are barely being utilized efficiently. Yeah. It's like running a giant factory almost empty. And that causes these enormous losses, which are then magnified by that high leverage.
So the lack of utilization at their Arizona factory, the AMP1 facility, is essentially the main culprit, pushing those production costs per vehicle sky high.
It's the primary mechanical reason, yes. Low volume spread across huge fixed costs equals very high cost per unit. But the future reward, and this is the bet the PIF and management are making, is this. If they can somehow dramatically increase volume, let's say move from maybe 20% factory utilization today to, say, 80% utilization in the future.
And the economics flip.
Potentially, yes. Their profits could, in theory, grow exponentially faster than their revenue because those huge fixed costs are already paid for. Every additional car sold after the break-even point contributes much more profit. They desperately need to ramp up volume and move past that break-even point, and they were clearly miles away from it right now.
Okay. Speaking of loss figures, let's quickly touch on management's own attempt to maybe soften the blow a bit. They're non-GAAP adjustment. Companies often use these adjusted metrics, like adjusted EBITDA, right, to argue that the official GAAP losses are inflated by non-cash expenses, suggesting the actual cash burn isn't quite as bad.
They absolutely did that here, yes. They provided an adjusted EBITDA figure. And just to remind everyone, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. The key word there is adjusted. That means management selectively adds back certain items they consider, non-recurring or non-cash. Typically heavy non-cash expenses like stock-based compensation get added back.
Right. So their official painful GAAP net loss was over $1 billion, $1,034.5 million. What did their adjusted, let's call it manager-approved number look like, and what exactly did they add back to get there?
Okay, so their non-GAAP adjusted EBITDA loss came in at $717.7 million. Now that figure is over $316 million better than the official GAAP loss, so it looks less scary on the surface.
$316 million difference is pretty significant. What drove that?
Primarily driven by adding back two main categories. First, $120.1 million in depreciation and amortization, which is a non-cash accounting charge reflecting the theoretical wear and tear on assets like the factory and equipment. Second, they added back $115.1 million in stock-based compensation, which is also technically a non-cash method of paying employees using equity.
Okay, but I have to challenge that adjusted number a bit. I mean, while D&A and stock-based comp don't drain the bank account today, they are real economic costs, aren't they? The assets are depreciating, and the stock does dilute existing owners. So why should we, the listeners, really care that the GAAP loss is $1 billion if the adjusted cash burn is supposedly only $717.7 million? Does that adjusted number even matter?
That's an excellent challenge, and you're right to be skeptical. The key takeaway, I think, is that even management's highly adjusted, more favorable figure still confirms a severe operational cash drain exceeding $700 million in a single quarter.
So even their best spin shows a massive burn.
Exactly. It shows just how aggressively capital hungry this operation is right now. The adjusted figure basically confirms that even after you strip out some of the non-cash accounting noise, they are still physically writing checks and draining their liquidity reserves at an absolutely alarming pace.
Yeah.
Those catastrophic margins are real, cash is flying out the door, and that pace just makes the discussion on liquidity, which we'll get to, absolutely urgent.
That terrifying burn rate does lead us right to the next question. Are they at least becoming more efficient in their production ramp? Are they making progress on the operational side, even if the costs are bad? Let's shift gears and look at the engine room itself, their actual operational progress.
Let's do that. Continuing to slide 3, the engine room business segment performance. Okay, so we absolutely have to acknowledge the clear positives here first. Lucid is successfully ramping up manufacturing volume. That's the necessary first step, right? Towards eventually utilizing that high operating leverage we talked about.
Right, volume has to come first.
In Q3 2025, vehicle production hit 3,891 vehicles. That marks a significant 116% increase year over year. That's more than double. And deliveries to actual customers were also strong, hitting 4,078 vehicles. That's up 47% compared to Q3 of 2024.
Okay, so production more than doubled, deliveries up nearly 50%. That production ramp is absolutely essential, no doubt. But it also highlights that disconnect we saw earlier, doesn't it? They're more than doubling production year over year, yet their gross margin is still collapsing towards negative 100%. That seems counterintuitive.
It is deeply counterintuitive. We'll come back to that. But before we return to that cost spiral, let's also acknowledge the strategic moves they highlighted. They're trying to build a narrative beyond just cars.
Right, the tech angle.
Exactly. Management highlighted several key strategic plays. They're aimed at trying to validate their high R&D spending and justify their valuation more as a technology company, not just a traditional automaker. They specifically mentioned deep collaborations with NVIDIA, focusing on level 4 autonomous driving technology.
That's the self-driving tech.
Right. They also talked about the development of a robotaxi fleet alongside Neuro, specifically for that big Uber partnership they announced. And they confirmed the concrete completion of Uber's $300 million strategic investment into Lucid. So these are all future bets, attempting to prove they have a technological edge over the competition.
Okay, interesting strategic points. Now let's try and connect the operational metrics, those deliveries, back to the financial revenue growth we saw on slide 1, because this is where a small, potentially positive trend seems to have been completely swallowed up by the costs.
Yeah, I noticed that divergence immediately as well. Look, vehicle deliveries grew by 47% year over year, right? We just said that. However, the total revenue grew faster. It grew by 68.3%.
Ah, okay. Revenue grew faster than units sold.
Exactly.
Yeah.
And when revenue growth significantly outpaces unit growth, the only mathematical explanation is that the average selling price, the ASP, must have increased. They're selling a richer mix of vehicles, more expensive models.
Okay, let's perform the calculation right here for the listener, just to demonstrate that product mix shift. It's important.
Sure. If we take the total Q3 2025 revenue that was $336.6 million and we divide it by the 4,078 vehicles they delivered in the quarter, we get an average selling price of $82,535.
$82,535 per car. That's a solid price point. Definitely indicates a premium luxury product.
It does. Now, to establish the baseline from Q3 2024 for comparison, given that the 4,078 deliveries this quarter was a 47% increase, we can work backwards. The prior year's delivery count must have been approximately 2,774 vehicles.
Okay, about 2,800 cars last year.
Right. And using the Q3 2024 revenue figure, which was about $200 million, divided by those estimated 2,774 deliveries, the ASP back then was $72,111.
72,000 versus 82,000. That's powerful evidence. Their average selling price increased by roughly 14.5% year over year. That should be a success story, right?
It absolutely should be. It confirms that customers are opting for the higher trim, more luxurious, and therefore higher priced models, maybe the Dream Edition or Grand Touring versions over the base Pure model. That naturally should lead to margin expansion. Better prices usually mean better profits per car.
So it's a genuine operational positive then. They are successfully commanding better prices, validating their premium brand position.
It is a genuine positive, yes. However, and this is probably the most unsettling reality of the entire earnings report, we have to immediately connect that positive 14.5% ASP increase back to the absolutely devastating gross margin of negative 99.1% that we discussed back on slide 2.
Right. Here's the paradox again. The puzzle seems almost impossible now. If they are selling substantially more high-priced cars, commanding a 14.5% higher price on average, how did their unit profitability not only not improve, but actually collapse further to the point where they're losing almost $2 for every dollar earned?
It can only mean one thing, really, and it confirms the severity of those supply chain and manufacturing execution issues that the CEO, Winterhoff, briefly mentioned. Is the cost of goods sold must have spiraled upwards exponentially faster than even that significant 14.5% price increase.
So costs went up even more than prices did.
Way more. It erased every single potential benefit they achieved from selling that better, more expensive product mix. This implies massive, unforeseen cost inflation during the quarter. It likely ties back to specific supplier constraints, maybe paying premiums for scarce components like high-performance battery modules or semiconductors. It could also mean higher than expected scrap rates from inefficiencies in the factory ramp-up, just basic execution problems costing them dearly.
So summing up this part, they are successfully building a better, more expensive product, and customers are willing to pay a premium for it. That's the good news. But the cost to actually execute that build is currently a financial abyss, wiping out all the gains.
That's the unfortunate reality.
This leads us directly, I think, to the most critical question of all. Where is the money coming from? How are they funding this massive spiraling unprofitability? Who is paying for these losses?
Exactly. That brings us to the lifeline. Now for slide 4, financial strength and shareholder rewards. Okay, this slide really is the financial lifeline, and it directly answers the second part of our listener's mission, identifying the central pillars supporting the company. Given the confirmed cash burn, we estimated at around $700 million per quarter, even on an adjusted basis, liquidity is everything. Their available cash and, crucially, their access to new funding, that's the single most critical factor determining their longevity right now. Nothing else matters if they simply run out of cash.
Right. So what did the balance sheet show at the end of Q3 2025? How much cash did they have on hand?
At the quarter's end, September 30th, their traditional cash and cash equivalents listed on the balance sheet totaled $1.635 billion. Now, management was quick to point out in their release that their total liquidity was higher, around $4.2 billion. That likely included undrawn credit lines they had at the time.
$1.6 billion in cash, burning $700 million a quarter. That doesn't last long on its own.
Not at all, just over 2 quarters. But the real market-defining event, the game changer, actually happened after the close of Q3, subsequent to the quarter's end. And it centers entirely on their largest shareholder, their main financial backer.
This must be the PIF connection.
This is the PIF connection. The Public Investment Fund is Saudi Arabia, the Saudi Sovereign Wealth Fund. This event is the absolute central financial pillar supporting Lucid's continued existence right now. What happened was Lucid secured a massive increase in their delayed draw term loan, which is basically a pre-approved credit facility they could tap into as needed from the PIF.
Okay, an increased credit line, how much bigger did it get?
Hugely bigger. They increased that PIF credit facility from the previous commitment of $750 million up to a staggering $2.0 billion.
Wow, from $750 million to $2 billion. That's more than doubling the available credit from the PIF. That is an overwhelming expression of confidence and, well, commitment from the sovereign fund, isn't it?
It absolutely is. It's a massive vote of confidence, or perhaps strategic necessity from the PIF's perspective. This decision effectively catapults the company's pro forma total liquidity, meaning the cash they have plus what they can immediately access from this facility, to approximately $5.5 billion.
$5.5 billion. Okay, that completely changes the narrative about their immediate runway, doesn't it?
Completely. It buys them significant time.
So the conclusion here seems pretty stark then. The company's ability to survive this period of catastrophic operational unprofitability is now entirely, almost solely dependent on the willingness of the public investment fund to continually fund these massive losses and keep expanding that credit line when needed. The PIF isn't just an investor anymore. They are effectively the sole underwriter of Lucid's current burn rate.
That's a very accurate way to put it. And that allows us to do a quick back-of-the-envelope runway calculation, which is the immediate practical application of this knowledge for any investor looking at this. If you take that $5.5 billion in total pro forma liquidity, and you divide it by that confirmed quarterly cash burn rate of roughly $700 million.
Let's see, 5,500 divided by 700, that's almost 8.
Right. That gives Lucid a cash runway of about 7.8 quarters.
Yeah.
So just under 2 full years, assuming the burn rate stays consistent, which is a big assumption, but it gives a baseline.
Okay, nearly 2 years. That is significant breathing room. It's not infinite, but it's substantial.
It buys them time. Critical time.
2 years gives them a window then to try and hit those production volume goals we talked about, get the factory utilization up, and execute the kind of cost restructuring they desperately need to fix those terrible margins. But what's the PIF's strategic interest here? I mean, beyond just acting like a piggy bank, why are they so keen to keep underwriting this venture?
That's a great question. The PIF's interest is deeply strategic and, frankly, nationalistic. Lucid has a binding commitment to build a second major manufacturing facility, AMP2, in Saudi Arabia itself. The PIF's continued massive funding essentially ensures Lucid survives long enough to fulfill that mandate.
Ah, so it's tied to building the factory in Saudi Arabia.
Directly tied. And that factory is critical to Saudi Arabia's broader Vision 2030 plan, which is all about diversifying their economy away from oil and establishing the kingdom as a major hub for advanced manufacturing, technology, and electric vehicles. The PIF isn't just buying shares or loaning money here. They are investing heavily in the creation of a domestic automotive industry. And they clearly view Lucid as the chosen vehicle, pardon the pun, for that ambition.
Got it. Okay, let's also quickly analyze their leverage situation. What does their debt-to-equity ratio look like? This metric compares their total debt to their net worth, their equity, and it's usually a key measure of financial risk.
Okay, looking at the balance sheet again, they reported $2,040.4 million in long-term debt. Against that, they had $1,800.4 million in total stockholders' equity. If you do the math, that calculation results in a debt-to-equity ratio of 1.13.
1.13. Now, in many sectors, a DE ratio over 1, maybe approaching 2, might be viewed with some caution. But for a capital-intensive automaker like Lucid, how does that 1.13 actually look in context?
You know, surprisingly, it looks manageable on paper, provided you completely ignore the catastrophic cash flow problem we've been discussing.
Right, there's always a catch.
Always. Automakers inherently carry very high debt levels just due to the sheer cost of building factories, tooling up for new models, massive R&D. We noted earlier, just for context, that an established giant like Ford was recently operating with a debt-to-equity ratio somewhere around 3.46. So purely on paper, Lucid's debt level relative to its equity base isn't the immediate flashing red crisis light.
But I have to challenge this again. You say the ratio itself looks manageable, but isn't that metric completely meaningless when they have negative $700 million in quarterly cash flow? I mean, how exactly are they servicing that $2 billion in debt, paying interest, without even more external funding from the PIF or maybe further dilution down the road?
That is the absolutely essential insight. Yes, you've hit the nail on the head. The core issue for Lucid isn't the amount of debt they have right now. It is the total lack of operating profit or positive cash flow available to actually service any of the debt they have.
They can't pay the interest from operations.
Exactly. Servicing debt requires positive cash flow from the business. Lucid has zero of that, in fact, deeply negative flow. Therefore, while the DE ratio might look optically okay or even healthy compared to peers, the company remains utterly dependent on those external infusions, primarily the PIF lifeline, just to ensure the interest payments on that debt are met and the debt doesn't become callable due to liquidity covenants or other issues. So yeah, the leverage ratio isn't the immediate problem. The underlying profitability needed to support any leverage is the problem.
Understood. Okay, and finally for this section, a quick check on shareholder rewards policy. This usually tells us if the company's maturing or still purely in growth and cash consumption mode. Any dividends, any share buybacks?
Very simple conclusion here. No dividends were paid to common shareholders during the quarter, and no share buybacks occurred either, which we can confirm by looking at the unchanged treasury stock line item on the balance sheet.
So firmly still in cash burn mode.
Absolutely. Lucid remains firmly in a cash consumption phase.
Hmm.
All available capital, whether it's the cash sitting on their balance sheet or the debt they draw down from that big PIF facility, is being directed entirely towards funding those massive operational losses and investing in future growth, like R&D and those strategic partnerships. No cash coming back to shareholders anytime soon.
Okay, this all brings us logically to our final synthesis then. How is management trying to frame all of this? How are they attempting to position these, frankly, catastrophic results for the future? What's the story they're telling investors?
Right, let's wrap it up. Finally, slide 5, the road ahead management's outlook and key takeaways.
Let's start with the operational side. Did the leadership acknowledge the problems?
Operationally, yes. The interim CEO, Mark Winterhoff, was relatively candid in the release. He acknowledged that the immediate focus has to be on ramping up production and addressing the significant supply chain disruptions. So that's a direct confirmation from the top that manufacturing execution, getting cars built efficiently, and sorting out their sourcing and supplier issues remain the primary operational hurdles they're fighting. The ramp-up is happening, as we saw with the volume numbers, but it's clearly chaotic and incredibly costly right now.
Okay, so acknowledgement of the operational pain. But strategically, reading between the lines of their statements, there seems to be a distinct and pretty aggressive pivot in the management narrative, right? Trying to move away from just being seen as a luxury car builder and positioning themselves more as a pure tech company.
Absolutely, yes. The CEO is meticulously working to shift that framing. He's leveraging those partnerships we mentioned, particularly with NVIDIA and Uber. The clear goal is to brand Lucid more as an AI, an advanced technology platform, explicitly aiming to be among the first to bring Level 4 autonomous driving to privately owned passenger vehicles.
And that framing serves a purpose beyond just sounding futuristic.
It serves a very specific financial purpose. This attempt to be seen as a tech leader tries to justify the absolutely massive R&D spending we saw earlier, remember? Over $300 million in one quarter. That spending is a huge driver of those negative margins. So they're arguing that this R&D isn't just cost, it's creating massive, unique technological value that traditional automakers lack, potentially justifying a higher valuation multiple down the road, more like a tech company than a car company.
Makes sense. And the CFO, Taufik said, he made sure to tie the financial footing back to the only thing that's really keeping them alive right now, didn't he?
He was very explicit about it. While he certainly paid lip service to focusing on cost management, the critical point he highlighted was, and I quote, the solid liquidity position, supported by the additional liquidity from the PIF.
There it is again, the PIF.
Right, that statement is the absolute foundation. We know we are bleeding cash profusely, but don't worry, our sovereign backer, the PIF, has refilled the bank account and given us a huge credit line. It's basically an open acknowledgement that the PIF's continued, unwavering financial backing is the bedrock upon which their entire future strategy rests. Without it, none of this works.
Okay, let's crystallize everything we've covered now into our 4 core facts. The essential takeaways derived straight from this structured 5-slide analysis we just walked through.
All right, let's synthesize. First takeaway. The quarter was defined fundamentally by the conflicted beat and miss. Yes, they successfully beat revenue expectations thanks to stronger demand and higher average selling prices. That was the beat. But the market immediately dropped the stock because of the major profitability miss, confirming that investors correctly focused on the core weakness, the uncontrolled costs.
Got it. Beat and miss, focus on the miss. Second point.
Second, that profitability miss was driven directly by those catastrophic gross margins. That negative 99.1% figure is the smoking gun. It means they lost nearly $2 in direct production costs for every single $1 they earned in revenue. The core unit economics are just non-functional right now, amplified by that low factory utilization and the high operating leverage inherent in auto manufacturing.
Unsustainable economics. Third takeaway.
Third, the apparent EPS improvement that looked good on the surface. It was purely an illusion driven by dilution. That narrowing per share loss was solely attributable to the massive 34.3% explosion in the number of outstanding shares used in the calculation. It represented a significant shrinkage of existing shareholder ownership, not any actual improvement in operational performance. Don't be fooled by the headline EPS.
Dilution masking the real loss. And the final, most crucial point.
And finally, number 4. The company's entire operation, its very existence at this point, is entirely propped up by and dependent upon the PIF lifeline. Their survival hinges on their largest investor, the Saudi Public Investment Fund, being willing and able to continue funding these massive operational losses. This is now secured for the time being by that newly expanded $5.5 billion pro forma liquidity position, which gives them roughly 2 years of runway at the current burn rate.
Okay, so the final narrative here sounds pretty simple, if stark. Lucid is in a desperate race against time.
That's exactly it. The positive trends they do have, like the higher ASPs and the increasing delivery volumes, are being systematically nullified, completely wiped out by manufacturing costs that are spiraling upwards faster than they can possibly increase prices or build volume efficiently. The central question for every single investor looking at Lucid today remains unchanged. Can they successfully restructure the cost of goods sold, get a handle on manufacturing, and finally transition to positive gross margins before that PIF-funded $5.5 billion liquidity pool runs completely dry?
The clock is ticking very loudly.
Extremely loudly, and the burn rate is intense.
So, thinking about our listener, what does this structured analysis we just did mean for you, the learner, maybe in the context of approaching any other complex company that you're researching? How can you apply this?
Well, look, we used this detailed 5-part framework, right? We looked at revenue versus expectations, then the engine of profitability margins, then the core operational metrics, then financial strength and liquidity, and finally, the outlook. We use that structure to systematically move past the company's spin and the confusing headlines to pinpoint Lucid's true financial drivers and its realistic runway for longevity.
Right, a repeatable process.
Exactly.
Okay.
Now consider this. You can apply this exact same process, scorecard, profitability engine, ops metrics, financial strength, outlook, to basically any other company you're looking at. Whether it's a legacy automaker like Ford or GM, or another highly speculative tech startup, or even something in a totally different industry. This framework helps you systematically determine its real viability, its underlying operational health, and the sustainability of its financial structure. Think of it as your ultimate shortcut to being strategically well-informed, moving beyond just the headlines.
A powerful tool. Thank you for joining us on this deep dive into Lucid's Q3. We certainly hope this structured framework helps you analyze your next complex investment decision with a bit more clarity. Just a reminder, this analysis is not financial advice. Listeners should always conduct their own research and due diligence. This content was generated by AI. Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.